Understanding market structure is crucial to forex trading. In this video, I will teach you how to identify uptrends, downtrends, and be able to mark a clear structure on the chart. Without further ado, let's dive in. Trending markets. So, we have two types of trending markets, an uptrend and a downtrend. In an uptrend occurs when prices makes a series of higher highs and higher lows, indicating that buyers are in control and pushing prices upwards. This shows a schematic diagram of an uptrend, making a series of higher highs and higher lows. HH means higher highs, HL means higher lows. So higher highs, higher lows, higher highs, higher lows. You get the point. So this figure shows an actual diagram in the market, highlighting the higher highs, higher lows, higher highs, and higher lows. In a downtrend happens when prices mix lower lows and lower highs, showing that sellers are driving the market downwards. This signals a general move towards lower prices, creating opportunities to sell. In short, when you are in a downtrend, you have to be looking for sale opportunities. This shows a schematic diagram of a downtrend. So it's lower lows, lower highs, lower lows, lower highs. You get the point. This shows an actual diagram of a downtrend on a forex market. So making a series of lower lows, lower highs, lower lows, and lower highs. These are textbook patterns. While they are simple to understand in theory, the reality of forex market can be chaotic and difficult to navigate. Understanding market structure is often overlooked, but it's one of the most powerful concepts in forex trading. You can have a perfect entry and exit strategy, but if you are on the wrong side of the market, you are likely to get stopped out. How to map market structure. In trending markets, whether an uptrend or downtrend, price moves by making a series of impulsive moves followed by a retracement. These terms are quite confusing, especially for beginners, but I'll try to keep it simple and present the best examples so that you can understand. The word retracement is sometimes referred to as a pullback. An impulsive move is when the market makes a strong, clear push in one direction without much resistance, showing that buyers or sellers are fully in control. These moves often set the tone for the trend and are followed by short pauses or pullbacks before continuing in the same direction. So this shows an impulsive move during an uptrend. This figure shows an impulsive move during a downtrend. A pullback. A pullback is a temporary pause in the market after a strong push in one direction. After an impulsive move, the price slows down and moves in the opposite direction for a short time. This pullback gives the market a chance to rest before potentially continuing in the same direction. Spotting pullbacks can help you find good opportunities to enter the market at a better price. Putting everything together, this diagram shows an impulsive move followed by a retracement or a pullback. In an impulsive move, when the market forms at least 3 candles in the opposite direction, with each candle closing lower than the previous one, it is defined as a retracement. Note that these candles don't have to be consecutive. This pattern signals a temporary pullback before the trend resumes. The highest point before the retracement is considered as the higher high. If the retracement ends and the impulsive move resumes, resulting in a candle closing above the higher high, it is considered as a break of structure, known as the boss. So, this is an actual chart or an example that I would like to demonstrate a pullback and a retracement. So in a pullback, which means, for instance, in an uptrend, the market is going upwards, these green candles marks a pullback, right? So the moment you have three candles that have occurred in an opposite direction, we define that as a pullback. So these three candles don't have to be consecutive, right? So as long as this is our first candle, we have another candle that has closed below the lower wick of this candle. We define that as our second candle. And then we have another candle that has closed below this wick of the second candle. That's our third candle. As you can see, this one is not considered as the second candle because its body didn't close below the lower wick of this candle. So in a pullback, to define a valid pullback, we need to have at least a minimum of three candles in the opposite direction. And then you mark the highest high or the swing high here, and then wait for the market to break above. So once it breaks above, this defines your pullback, right? And then you wait again for a minimum of three candles. A minimum means greater than or equal to three candles. Another example, just to drive the point home. As you can see here, I've got this impulsive move, right? Even though we have a green candle here, but we can't define it as a valid pullback because our rules have clearly said we need to have a minimum of three candles in the opposite direction. So right here, that's when our rules starts to align, right? So the first green candle, second green candle, third green candle. The moment you have a minimum of three, that's what we define a valid pullback, right? And then you mark the lowest point here, and you wait for the market to close below this swing low, right? So everything happening inside here, we call it as the internal structure. You don't have to be trading here, right? This is an internal structure. So most of the times, what people find themselves doing is that they tend to trade in this internal structure, like defining, oh, this is an uptrend, and then there's a shift in market structure. Now we're in a downtrend, and then there's a shift. Now we're in an uptrend. You can easily get stopped out when you're trying to look for structure inside here, right? So this is an internal structure. You need to stay away from trying to market structure inside here. Yeah. Trade how to market structure on NZD CHF by following our rules. So usually you need to start a little bit like way behind the charts, not actually the recent one here. So it's highly recommended like to study the past or to study the past structure and then later on to determine the present conditions of the market. So I will start here to do the present market conditions. So yeah, as you can see, our rules. This is an impulsive move, three candles in the opposite direction. So this will mark as our highest point, then the lowest point. Again, I've experienced a break above, an impulsive move here, three candles in the opposite direction, 1, 2, 3, we'll mark it here. So we're going again, as you can see here, we had this a retracement, but it didn't have a minimum of 2 candles. So we won't consider this as a retracement because you had 1, 2. As you can see, the third one didn't actually close below the second candle, so it's not an impulsive move. But this one, the highest point and then the lowest point, you wait for the market to break above the structure. it's an internal range, right? So what's happening here right now? The market has managed to break above a minimum of 3 candles in the opposite direction. So yeah, from here to here, and then here, this is our internal range. Anything that is happening here is our internal range. It's either we wait for a break below that will signal a change of trend, or a break above. That's our continuation.